Tom Lee is out there making a lot of content and podcasts, and this is what we love, because with every single podcast and every single clip, we can find something new about the chairman of Bitmine. And I believe that when you're investing and when you're researching, you always have to go 1 mile deep instead of 1 mile wide, okay? So in this video, we will talk everything about recession, what it means to have inflation, valuations, and in the end of this video, so it's important to stay to the very end, we will talk about what this all means for Bitmine. So let's dive in.
Welcome to the game, I'm the wolf of Dubai.
If you don't know who I am, my name is Danny and I'm looking for stocks that can go up 10, 20, 30x. But we start with a 10x with Bitmine. What a fantastic day for Bitmine in general. If you want to know why, I made a whole video on my main channel. So make sure to subscribe to both channels at the same time, okay? And I also have our extend day trading group. If you want us to trade for you all automatically, we want to achieve about like 8 to 15% per month. And that means that if you start with $10,000, you should be somewhere around like $58,000 in the end of the first 12 months. And then, you know, we do this for many, many decades together. So if you have $10,000 to start, check out extenddaytrading.com. Now, let's dive into the first clip of Tom Lee and let's analyze what he actually says.
Your transition from a fundamental equity analyst to a strategist obviously couldn't have happened overnight. I mean, you may have gotten a new job, therefore you can say it happened overnight, but the way you think about investing, markets, and forecasting could not have happened overnight. So can you share a bit about that transition?
I think it's actually been one of the strengths that we've had doing macro research is that we come from a stock picking, bottoms up research world.
Right.
Most equity strategists are macro people that are economists. And then they may follow economic data, but then they build what I would say is a stylized model of the economy and the stock market using indicators. They might say, I'm using PMIs or, liquidity or earnings. But we approach the world at Fundstrat more as the stock market is the composite results of the 500 names in the S&P. So I always think of it as these are individual companies that comprise the index. And the reason that evolution came for us was that when I was doing wireless, I had to do quite a lot of thematic work because it was a new industry. Many of my clients never heard of wireless, and there was also a very big age difference. Most people who manage money are in their 40s or 50s. Wireless was a new technology, and I was in my 20s at the time.
Right.
And I quickly learned young people adopt technology which most investors don't understand and they're skeptical of. And I witnessed it. We witnessed it many times since, whether it's social media and how people dismissed Google and Facebook, or how people have missed crypto, or even how people missed AI. A lot of people were dismissing AI just 2 years ago saying it's not going to work. People are too optimistic and look at AI now. So I've learned to look at the world through younger people's eyes. And so much of the work I did as a technology analyst was thematic, large think pieces I would publish. And I was at JP Morgan at the time, and they found it as the work I did was helpful to teach other analysts. So they had asked me to become the mid-cap strategist in around like 2006 or so. Mm-hmm. Around that time, JP Morgan opened up a new research office in India, which was underutilized, had 40 analysts. And so one of the projects I thought of doing was to look at bankruptcies because wireless companies were going bankrupt. And so I sort of put this task list together to go through over, I think, 4,000 or 5,000 bankruptcies since 1970 to follow what happened to these companies. And it turns out that many of these companies that come out of bankruptcy come out much stronger. And so we wrote a book called, or a white paper called Chapter After Chapter 11, which became very popular, but it was basically recommending certain stocks as they came out of bankruptcy. So I was a mid-cap strategist for a while, doing bankruptcy research and wireless. And then in 2007, they asked me if I wanted to take on the larger role as the head of macro strategy. And that's when I started to do it. And sorry, it's for a long-winded answer, but at the time I was doubtful I should do it because I still viewed myself as someone who looks at 10 Qs and picks stocks.
Right.
And I didn't think anybody could actually forecast the stock market itself. But what I said was I would study it, and I did, and I came up with our own approach, which included those first principles I mentioned. And we started to write about the stock market in that way, which was very different than most strategists. Because most strategists will be like, oh, the ISM's at 45, which implies S&P earnings growth of X, and then you just throw a PE on it, and that's where the target is. And I could never believe that would actually work. So we come up with a very different approach. Is we view this as stocks, what stocks could lead, and then how does that drive the value of the index.
So as you can see, he's giving us a little bit of a hint that he really have like a research to his analysis. Okay, for him, it's not enough to say, okay, this company can have this PE and this means this price target, but to really make the extra work to research. This is also my personal philosophy. If every single trade that I made or every single investment that I made, I deep dived the huge hole of research knowledge that everyone investor has when he invests in a stock. I'm also a big friend of just investing in a stock and then, start your position and then research all what you could, because then you have like skin in the game. Then you have like more motivation to do that. And, that's why we are so deep diving always into Bitmine every single day, 2 videos. So you can get a lot from every single video, even when it's just a minute of content that's totally changed the view for you forever for Bitmine. So let's dive into the second club.
So speaking of that, your S&P 500 target, whether it's the near term, 6,000 by year end or 15,000 by 2030, it comprises multiple assumptions. What are the key assumptions, and which of those assumptions do you have the least confidence in?
I might answer that by explaining that a mistake most people make is putting too much credence and weight on PE. Okay, so in other words, when people talk about the stock market, you'll hear a lot of experts say, oh, well, the PE should only be 18 times or 15 times this earnings, and therefore the stock is a sell.
Right.
I never understood it because number one, in Wharton, when I took all my classes on finance, no one ever actually said PE was something tangible. PE is a residual calculation.
Right.
You have the price of a stock, and then you have a fundamental metric. Now, it could be earnings per share, it could be cash flow per share. What we never know is the reality is which earnings period are we looking at? Are we looking at last year's earnings or earnings 2 years from now or 20 years from now or next quarter? Are we more caring about cash flow or earnings or EBITDA? And then what's the right risk appetite? Because a PE in a world of 10% inflation is different than a PE in a 2% world. A PE is different if there's high cost of money or high risk aversion. So I always view PE as a residual calculation and actually not that important. And so when we think about where markets can go, we tend to think of it as how much we do stick with an earnings concept. We need to know what earnings power is.
Right.
But we're not anchored by it because earnings delivery can change because of concurrency, labor cost, margins, government policy, buybacks. So we think of earnings as sort of a base case. And then we sensitize it and ask, could earnings do better than expected or worse? And then we think about what that would mean to the PE. So we're not as anchored to the idea that, oh, hey, the forward earnings of the S&P is at 19 times, which it is today, the index. So it's a sell. Or someone will say small caps, PE is 24 times, so it's a sell. The reason I don't like that concept is that, one, there isn't really S&P earnings per share. It's the earnings of all these companies. And in the S&P today, for instance, the Mag 7 trade at 29 times earnings. So it makes the market look expensive. The median PE in the S&P is 17 times forward earnings.
Right.
And that's not at equilibrium. It's a it's a moving target because earnings could do better or worse. The median PE in the Russell 2000 is 11 times. Now, over 30% of the Russell 2000 doesn't make money, but the vast majority of those that don't make money are biotech companies, and then there's a lot of regional banks, but regional banks are doing poorly because of monetary policy. So I'm not as constrained about what the Russell PE should be because I think the earnings could move a lot more in the next couple of years.
Got it.
So in this clip, you see that he's taking like a much broader approach to the stock market analysis. Okay, for him, it's not only, looking into those price-connected metrics, but also the overall market sentiment. Seasonality is huge for him. Market and historical data is also what Bitmine's chairman is using a lot. Of course, as we know from all his presentations for Bitmine, and we know that he is always looking for that little edge that then he can create those crazy price targets for Bitcoin, for Ethereum, right? And he also gives us regular price targets for the stock market, the S&P 500 in general. So you can be sure that, he always is right on the price target, but most of the time, not the timeline, because that's obviously the hardest part. I can also say like, okay, Bitmine can be, $65, but I don't know if it will be, tomorrow or next week, right? I know just that it will come to this point essentially, right? We're already at 60, 61. So, that's just a small 10% jump, and this can happen quickly for Bitmine. But nobody can really tell you when things are happening because the market is just so huge and influenced by so many things, okay? But we can also predict short-term movements and see what sentiment can do for stocks in the short term, and then we can trade on them. If you want us to do that for you, check out xtendaytrading.com. If you have $10,000 or more, schedule a call with me personally, and we see if we can help you as well. Now, let's dive into the next clip, and this will be quite interesting.
The economy hasn't had a broad-based recession since 2020. And arguably since 2009, depending on how one considers the 2020 COVID recession. But there's been pockets of recessions, whether it be durable goods, housing, unprofitable tech, or early stage venture, M&A, IPOs, and even crypto. Minus the major ones. A lot of the ones that probably should have never existed have all crashed. Is that it? Meaning, that's the recession that we were supposed to get this time around, a collection of isolated recessions?
In a way, what you're describing are rolling recessions, right? Because pockets of the economy are contracting, but it's not large enough to cause the entire economy to be in a contraction cycle.
Right.
I think business cycles are very mysterious. I mean, if you use the NBER's dating system for recessions, and from 40 to 1990, economies were really frequent. In fact, the U.S. probably spent close to 40% of the time, 30 to 40% in recession. So in other words, in 10 years, you have 4 of those years are a recession. I mean, which is a lot of the time. Mm-hmm. But it made sense. Back then, manufacturing, which is super cyclical, was a large part of the economy. And as you know, there's the bullwhip effect around manufacturing, which leads to over-ordering and busts. So the economy, U.S. economy was a boom bust because manufacturing was such a big part of the business cycle. Since the 80s and 90s, the U.S. economy has evolved, and globally it's evolved. First, it's because the service economy has grown. Now, service is an encompassing word. It means healthcare, financial services, tech, transportation. Mm-hmm. But the service economy itself is less cyclical. It's steadier.
Right.
And government spending has become a larger share. So manufacturing, which has gone from being the largest share of the economy, is now arguably the smallest share.
Right.
And therefore, we should have fewer business cycles, which has actually been the case. Now, that business cycle volatility has been pushed to other countries which do more manufacturing. That's why Asia is more of a boom-bust economy. And believe it or not, Europe is primarily a manufacturing economy. Germany itself is one large manufacturer. And so Germany and Japan and Asia spend twice as much time in recession as the U.S. So the U.S. is essentially a consumer economy with a huge amount of accumulated wealth. The household net worth in the U.S. today is about $150 trillion. Let me just put that in perspective. The U.S. GDP is $25 trillion. So U.S. households have saved or have a net worth that is roughly 6 to 7 times the U.S. economy.
Right.
We could shut down the entire U.S. economy and we'd still have GDP because the U.S. consumer has $150 trillion of wealth. That is by a country mile. We are the wealthiest. The U.S. is the wealthiest nation. And I think that's why the business cycle is less tied to economic activity and maybe even more sensitive to the stock market. So it's the trade-off is, of course, the stock market has a psychological impact on the economy. So if we have a stock market crash, we're almost guaranteed to have a recession. Other countries could have a stock market crash and it wouldn't affect their economy because very few people own equities. So that's, I think for someone who's looking at the U.S., that's something to keep in mind. And do I think the U.S. should have a recession now? I don't think so. One comprehensive measure is how much debt has been borrowed. U.S. companies have not borrowed a lot of money. It's been expensive too. And the debt that they have is low cost because they locked it in. U.S. households are underlevered. A measure is called the debt service ratio by the Federal Reserve. It's at roughly 10% of disposable income. Past recession peaks, meaning when leverage gets too high, it gets towards 14 or 16%. So consumers could borrow a lot of money. The only part of the economy that's overlevered is the U.S. government. But the U.S. government has never triggered a recession because they had too much debt. They could trigger a currency collapse, but not a recession.
So he's actually saying that we are, the stock market is always like a much better, let's say, representation of the overall economy, okay? Because think about it. If companies will not do well, they will tell us in the earnings, people will have less money to invest into stocks, and all of that would bring the markets down. Well, this is not happening over the last couple of months, obviously, as we have seen, we're going from all-time high to all-time high to all-time high, and that's why I think it's very, very important to understand, okay, the market is not the economy and the economy is not the market, but the market is much more telling than just taking the job data, for example, or just having, the PE ratios, compressions or extensions, right? The PE ratios goes higher or lower, or let's say inflation numbers, because, the market is having like all participants, right? It has the retail investors, the hedge funds, big institutions. We have the companies itself buying their own stocks as well, right? So you can see that this is a much better, kind of telling of a recession or not a recession. And the market at the all-time high says, or screaming actually, rather we don't have a recession. Also, we have the Fed that's actually having the Fed meeting end of this month. And if they cut again or just stay stable, it shows you that they are actually making money cheaper, which is helping the economy. So the recession fears are actually overblown.
So speaking of household wealth and borrowing, asset prices of various kinds, whether it be stock market, gold, Bitcoin, home prices, are at or near records, which means that wealth is at or near records currently. And the Fed is about to make borrowing cheaper, or it's already started to do that. Why wouldn't this reignite inflation?
I think that there is not a direct relationship between asset prices and inflation. Many people think there is, and there logically should be, but we know many instances in many countries where you've had asset prices rise and it has not triggered inflation. In fact, you might even have some countries that are suffering from deflation. Inflation, which is a mysterious phenomenon, is best traced to, I think, in the Fed is acknowledges, to a change in how consumers and businesses expect price changes to take place. So if a consumer owns a lot of stocks and it's gone up, it doesn't mean that they expect the price of a car to go up or the price of a house. House and the car, by the way, is 60% of the CPI basket. So if those aren't going up, then is it hotels, restaurants, clothing? These aren't necessarily tied to stock prices. They are tied to wealth and spending ability. But the flip of that is the stock market isn't held by everybody. You know, most of the wealth of the stock market is held by a small percentage of households. So asset prices making new highs is not the sign of a top. In fact, in a bull market, you'll be making new highs all the time. You know what I mean? Like,
Right.
if you're in a bull market for stocks, it's always going to make a new high. So you can't say it's topping. I would say, to me, when the last stock that should never have a high multiple gets a high multiple is really when you get a top. And, you know, when I see financials trading at 10 times earnings, a lot of staples have derated. I mean, small caps at 10 times earnings, I'm not sure it's a top.
Speaking of high multiples, Goldman recently made a prediction that the S&P 500 would return 3% a year for the next 10 years, citing, among other things, near record CAPE, cyclically adjusted PE, and concentration in the index. You know, the call itself, the prediction itself is an opinion, but the CAPE and the concentration being near records, these are observable facts. You're long-term bullish. How do you take the same facts and get to a long-term bullish conclusion?
Well, I haven't seen the Goldman report, and so I can't speak to how they got to their conclusion. I won't doubt that they have done some work and they can show some charts. But I would just point out that cyclically adjusted PE, if we look at the chart, you would have actually sold the S&P already in 2014. So you would have been out of the market for the last 10 years because you revisited all-time highs on CAPE. So my guess is that someone who did this analysis in 2014 at an all-time high CAPE would say the next decade would have subpar returns, and the S&P has been 13% a year.
Right.
Second, I think that that's another example of what I would call someone doing high-level analysis to explain stocks. Does this analysis capture the impact for AI? Does it capture the changes that could come with onshoring, with the changes in government policy around cost of energy? Does it capture demographics? None of those are reflected in a CAPE, and none are reflected in concentration. So I'd almost say that someone who would lend credence to that view is giving up all the discipline about equity investing in the first place. I mean, just as an observable fact.
Right.
That would be like someone saying, Tom, forget everything you know about investing and just look at one metric. But here's another intuitive way to look at it. If someone says the market's going to grow 3% a year, well, what will earnings do? Are earnings going to grow? Well, let's say GDP is 3 real, so that's nominal of 6 plus buybacks. So you have 9% earnings growth. So are they saying PE would contract 6% a year? So the PE is at 17 times now? Well, in 10 years, the PE would be down by 70%. So they're saying the PE goes from 17 to 10. Okay, so if PE goes to 10 and earnings grow at 9, we'll have 3% total return. But is that a reasonable base case? I mean, I don't know.
What about the concentration piece? That in order for the S&P 500, the cap-weighted S&P 500, to deliver strong returns over the long term, the top companies need to deliver high rates of return to stocks.
It's actually not true. If you look at every 10-year period, 40% of the S&P return comes from companies that were not part of the index at the start of that period.
Right.
So 10 years from now, only 60% of the index will be the same. 40% are completely new companies. Are these 40% going to deliver worse earnings growth? I mean, I'd be skeptical. Secondly, when people talk about concentration, the largest stock in many countries is often 27% of the index, whether you're looking at the UK, France, Germany. You look at most Asian countries, typically the largest stock is over 20% of the index. The largest stock in the US is 7 or 8%. I mean, we don't really have the concentration other countries have.
Right. What is an idea of yours that is most overlooked? In other words, that one pitch that you just can't get enough people to pay attention to.
Well, there's two kinds of skepticism. The one that we get the pushback on consistently is Bitcoin, because we've recommended at least a 2% allocation to crypto for 8 years now. That original recommendation would now be 40% of their portfolio without rebalance. If they owned a little bit of Ethereum, it'd be 80%. But today we still get people telling us, well, Bitcoin doesn't do anything. But it's gone from 1,000 to 72,000. The second thing that we get pushback is the idea that people in general think of us, if something isn't working now, it'll never work. And that is small caps. I think small caps could really be the star of the next decade. And it's because they've derated so much, but these aren't bad businesses and they're under-owned today. And in fact, people are so liquidity centric that they tend to avoid them. So I think there's a big opportunity in small caps.
In this clip, I think the most important is that the most overlooked trade or the bullish trade that he cannot tell enough from is Bitcoin. Or in general, obviously, he means also crypto. And specifically, if he talks about Bitcoin, he thinks that Ethereum and Bitcoin is anyway in a relation, right? So when Bitcoin goes to 200 and 250 towards the end of the year, we should see around like 10 to 12 to maybe even 14,000 Ethereum. And then you can even imagine what this can mean for Bitmine. And I think that the stock price of between like 100 and 150, and the most bullish case, if we're going absolutely crazy, will mean that he's still on to like the price target of Ethereum of like $16,000, which is essentially his fund strat price target for the end of the year. That means that we could see a 4 times bigger price target for Bitmine. And if this happens fast, obviously the price of Bitmine goes fast up as well. Okay, so that's number one. Second thing, I think that he's also telling us that the most important thing is to not focus on the downturn, because the downturn happened only like 30% of the time in the whole market years of the last 50 years, okay? What really matters is that you have to do your research. You have to understand that research is based not only by metrics, but also by deep understanding what moves the stocks, and then also what the Fed is doing, okay? If the Fed is dovish, that means that we can be quite happy for the next couple of weeks. And this can be quite brilliant in a case of Bitmine, because Bitmine will be a stock when the stock market just expands further and further, will be one of the top performing stocks together with Ethereum and the other risk assets out there. So I hope you liked it. Check out xnDayTrading.com and see you tomorrow, because the grass is greener on the other side.